Welcome to Moving Business Forward. I am your host, Roman Gaida. With me today is John Carroll, Chief Credit Risk Officer of ENGS Commercial Finance.
Hi, thanks for having me.
Hello, John. John, can you explain what is your role at ENGS as the Chief Risk Officer?
Well, all things risk management.
Okay.
Formulating our credit risk strategy, determining what types of credits we want to have in our portfolio, doing cradle-to-grave risk management, which really means starting from the application decisioning, our underwriting process, determining which accounts we're going to have in our portfolio and how we're going to structure those transactions, all the way through full life cycle management of those contracts and those accounts, through customer service, through add-on sales, and then unfortunately also for defaulted accounts, through the collections and repossession and post-charge-off recovery process. Again, overall risk management, loss forecasting, et cetera. And then in addition to which, I'm also in charge of compliance.
Wow, okay, that's a lot. So what are three things that keep a Chief Risk Officer up at night?
So sometimes it's hard to come up with just three things. I'd say the number one thing really is, again, credit losses. Credit losses are the thing that takes down banks and finance companies. If you go back in history and you look at the banks and finance companies who are no longer in business, they're typically no longer in business because losses got out of control. Right. So ensuring that we've got a handle on the potential for any credit losses and our strategy around those. A subset of losses is actually what we call fraud losses, and fraud losses are different from credit losses. Credit losses typically are a customer comes in, they fully intend to pay, but something happens to their business and they're not able to finally pay. There was full intention on the customer's part to pay. Right. Fraud losses are different. Fraud losses are where the customer has no intention to pay from the very start. And so in many cases, they're actually using stolen identities or fraudulent identities. And the challenge with fraud losses is they're harder to actually catch because if you're going to use a stolen identity, you're going to make sure that's a good stolen identity with a good credit. In addition to which, fraudsters tend to exploit any vulnerabilities that they find. So if they find that they can get one loan approved, they're going to send another 10 applications or 100 applications in that look just the same in order to try to exploit that. Fraudulent activity, I should say, something we're seeing more of now. Thankfully, we haven't seen very many fraud losses. We've been able to catch most of that. The third thing that keeps me up at night really is something that's going on in the economy right now. You're probably familiar with it on the automobile side. You've heard a lot in the news recently about the increasing prices of automobiles, both used and new automobiles, because of the supply chain issues, the chip shortages. There's a lack of supply of new cars, and that's raising the prices of both used and new cars. Right. The same thing happens with the commercial equipment that we finance, whether we're talking about 5-axis machining centers, or whether we're talking about a over-the-road truck like a Peterbilt tractor trailer. We have seen the prices of that equipment really jump up recently. And as a risk manager, what your concern is that we're using all of that equipment as collateral for our loans. And so in the event of a loan default, we get that equipment back and it offsets most of the losses. When you suddenly increase the price of that equipment, increase the amount that you're funding that equipment, that's fine as long as those increased prices are going to stay there long term. The challenges that we all worry about is what happens a year or two from now. Do the supply chain issues get resolved and do equipment prices come down? And now suddenly have we financed that brand new Peterbilt for too much money? And is the loan to value of that equipment relative to the loan balance, is that out of whack? And will that result in the potential for higher future losses?
Got it. Okay. Well, thank you very much. This has been a discussion with John Carroll, Chief Risk Officer at ENGS Commercial Finance.
Thank you.
Thank you, John.